very good evening and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now today I'm joined by Paul Leonard. He's the regional head for the Eastern Cape at Citadel. Now he joins us to help us navigate this very tricky and volatile landscape that we find ourselves in, and fundamentally how investors need to position themselves and set their minds when it comes to seeking alpha on the market. Always good to have you with us today, Paul, and thank you so much for making time to speak to us. Perhaps paint a picture for us broadly as to where we actually stand when it comes to the amount of volatility that we see on the markets at the moment.
Well, yeah, it's been very volatile, as we know, since the end of last year, and especially the beginning of this year. Markets were falling all over the place, and investors are nervous. Investors are very nervous, and it's at times like these, Gugu, it's very important to know how we should behave in markets like these, because markets are behaving pretty badly right now. But I think what's very, very important is for us to speak to investors about the fact that it's not how markets behave necessarily that causes us to, or that detracts from wealth, and that destroys wealth. It's how we as investors behave in those markets that determines whether we destroy wealth or not.
Why is behavioral science so important, Paul? And I understand you do have a brief explanation as to the typical pitfalls that us as investors and consumers tend to fall in.
Well, Gugu, we are not economists and we don't think rationally, although we like to think that markets behave rationally and people behave rationally in those markets. We don't. Many of our decisions are based on emotional reasons. And you could say that the markets are a reflection of the collective psyche of investors around the world.
You've clearly highlighted the importance of behavioral science here, Paul, but perhaps if you can give us a little bit more detail and flesh it out with the presentation that you're about to bring on screen at the moment.
So there's a lovely metaphor that my colleagues and I at Citadel use, and I'm just bringing the first slide up. And it's a metaphor of the Comrades Marathon, and particularly Bruce Fordyce, who was the Comrades king in his day. Of course, he won the race more than any other athlete. Now, Bruce says that there's a couple of things you need to do to win the race, and he had a particular strategy. He says that on race day, he needed to run at an average pace of 3 minutes 30 to 3 minutes 40 per kilometer for the entire 90 kilometers. But of course, not every kilometer is run at that pace. Some are faster, some are slower. So on the up run, just before Pinetown, there's a downhill called Cowie's Hill, which you can see on your screen right now. So he'll be running a bit faster, and a TV commentator might say, wow, look at Bruce Fordyce go, he's running at 3 minutes per kilometer, he's going to smash the record. But of course, a few minutes after that, he'll be running up Fields Hill. Now, there he might be running at, say, 4 minutes per kilometer, or maybe 4 minutes 30 per kilometer. And a different commentator might say, wow, what's wrong with Bruce Fordyce? He's running so slowly, he won't even be a contender in this race. But of course, both comments are inaccurate or inappropriate, because they're too short-sighted. You can't just look at running down Cowie's Hill, and you also can't just look at running up Fields Hill. You must look at the average pace over the entire race. And the average over the entire race needs to be between 3 minutes 30 and 3 minutes 40. And now, Google, how this translates very nicely into an investment metaphor is to say that investors also can't just look at the last month or the last year and say, wow, look how great the markets are, or right now, wow, look how bad the markets are. In fact, they've got to zoom out. Looking at a period that's too short in behavioral finance is called myopic loss aversion. It's when we're too short-sighted. And so the investor has to look at their investment portfolio over the appropriate time horizon. So if you're looking at a very low risk, low volatility portfolio, 1 year might be appropriate. If you're looking at a medium growth, medium volatility type portfolio, you might need to look at it over 3 to 5 years. And a more high growth portfolio, an appropriate time period might be 7 years or more. Now, we told this story to some clients, and there was a client who came back for a review quite recently, and he knew that the markets had been rough, and he knew that his portfolio was probably down, and he hadn't been looking at his investments too often. And we were about to go into the part of the meeting where we discussed the portfolio and its performance, and he said, just before we look at this portfolio, are we busy running up Fields Hill at the moment? And when he said that, I knew he's got it. He's okay. He knows that he's not going to be he's not going to become emotional or panicky about the current market conditions. And so it was a lovely metaphor to talk him through, and a lovely way in which he'd been coached to stick to the strategy, which is the important thing for investors.
The beauty about it is that you certainly had a client who understood what they were referring to, but how does this tie into going back to the fundamentals, which entails a sound and solid financial plan? And how important is it to have a long-term outlook when it comes to your investment strategy?
Very, very important. In fact, as I mentioned earlier, it's more the behavior of the investor himself or herself that determines whether or not they'll be successful versus the behavior of the markets. Now, the markets are unpredictable, and they're a very complex system. You could say. I mean, in a simple system, you can say if you do this, put this as your input, then that will be the output. But the financial markets are so complex, and there are so many things and variables that come to play at any point in time that you can't predict what's going to happen. You can't even predict what type of investment style or strategy is going to work best for the next 12-month period. We'll only know that in hindsight. So because you can't predict, what you need is a sound intellectual framework and a sound strategy for making your decisions and guiding you through these things. We too, as investors, need to ignore what other investors are doing. We also need to ignore the noise in the market. And then, as long as we have a sound intellectual framework that we've used to create our strategy, we need to trust the strategy. Just like in our story, Bruce Fordyce trusted his strategy, and it worked for him. He won the race more often than not. And we've now seen, in fact, back in the 2007 to 2009 market drop that we went through, we had a client who'd also listened. We'd also told him this story, and he stuck to the strategy. It was about 2013 when we did a comparison, and back in 2008, or toward the end of the bottom point of the market, the beginning of 2009, he really wanted to take his money out and stick it into cash, because he just said, I can't take this anymore. And we told him the story, reminded him of the strategy, and we said, just trust the strategy. It works. We've been through this before. It works. So he did. And in I think it was around 2013, 2014, we did a comparison between what he would have had he gone into cash and what he did have because he stuck to the strategy. And the difference was about 3 million rand of value in his portfolio. So that one decision, so that shows us, Gugu, the importance of having a long-term strategy to guide us through these turbulent times, and then sticking to that strategy through the turbulent times. So it's our behavior as investors which can detract or add to, or detract value or destroy value in our portfolios. Just like that story, had that guy actually acted on his panic and cashed in at the bottom of the portfolio, it would have made a difference of 3 million rand over the next few years to him.
I'm glad you touched on that, because it certainly highlights the level of discipline that investors need to have. But given the fact that you did touch on a strategy, how does this also tie into asset allocation and again, ensuring that the type of strategy you implement is one that's best suited to the individual? Given the fact that equities are so rocky at the moment, is it advisable for some investors to look at alternatives?
Well, once again, you don't change strategy because the markets have changed. You change strategy because your needs have changed, or what you're trying to achieve has changed. We know that equities are volatile, and in fact, there was one more quote that I saw from John Maynard Keynes, which I'd like to just read for you here, and he says that, investors may be quite willing to take the risk of being wrong in the company of others, while being much more reluctant to take the chance of being right alone. So it speaks once again to this panickiness of that something. But coming back to the asset allocation, I mean, what we believe is that you should have your short-term needs should be catered for in less volatile asset classes such as cash and a more balanced portfolio for the medium term. And what that does is, if you can then just leave your growth section of your portfolio alone without being forced to draw and dip into it on the short term, you can ride that out. And there's plenty of research done by academics overseas who show that this particular approach will work. So you do want different pockets within your portfolio. We know that over the long term, the asset allocation ultimately drives the long-term return you get. But you need to set your portfolio up in such a way that you give it time to deliver the returns without having to respond, without responding rather to the emotions on the short term. So absolutely, I mean, over the long term, equities are still going to deliver the returns. What we're seeing right now is normal. I mean, they haven't moved anywhere. They haven't moved outside of the range of returns that we expect from time to time.
Well, we've certainly said quite a bit, Paul. Let's get a quick recap now of the key takeaway points from tonight's discussion. Paul, in summation, if you could give us some of the key themes that viewers need to bear in mind this evening when it comes to personalizing their investment strategies and understanding their behavior and the impact thereon.
So it's key, if you're going to be successful in the long term as an investor, to have a strategy and a sound intellectual framework that you use to make your investments and to create your financial strategy. The next key is that you stick to that strategy. Don't be confused, or you need to, when you're evaluating the performance of your portfolio, you mustn't be too myopic, and you must avoid what the behavioral scientists call myopic loss aversion. Don't look at investments over 1 year if an appropriate time horizon is 7. And finally, don't be subject, or don't fall foul of herd mentality. Stick to your own strategy, as we said in our comrades marathon metaphor. Bruce needed to run at an average pace of 3 minutes 30 over the entire race, but some of those kilometers would be downhill and some uphill. So there'll be some faster, some slower, as we see in the market. Look at the averages, and then don't be worried about what other athletes are doing. In other words, don't be distracted by what other investors are doing, and also don't be distracted by noise in the market. Just stick to your strategy.
Stick to your guns and have a sufficient plan in place to ride out those waves. Thank you so much, Paul, for joining us this evening. Your time is certainly appreciated. A big thank you to Paul Leonard, who's the regional head for the Eastern Cape at Citadel. Now, do remember that we want to hear from you, so to continue to share your insights with us, you can tweet your comments to @CNBC Africa using the hashtag Finance410, or to myself @Gugulethu. Until next time, have a wonderful evening.